there's easily the potential for more of that to come through and ripple through, and it could be a whole host of things, and it probably the disruption, to be honest, is something that nobody's thinking about, nobody's forecasting, is not in anybody's outlook. It's some black swan, some unknown event, which is why part of the reason we want to manage money, we do manage money the way that we do, with a technical process that is responsive and able to change and adapt based on changing market conditions. This is the Realize Your Wealth podcast by Aretec Wealth. We want you to be wealthy. We want you to feel wealthy. We want you to realize your wealth. Right, here we go. It's Friday. We're back. It's 2026 here. We're into the new year. We're off to a very, very interesting start to 2026. Looking forward to getting into things, lots to unpack and dive into today. But how you doing, Greg? You feeling good? You ready to roll here?
Yeah, absolutely. It's a new year. I mean, so far markets are moving in the right direction. Our portfolio is actually, doing quite well. So we're kind of picking up where we left off in 2025.
Oh yeah. Oh yeah.
Excited for the new year. But what about you, Will? Have you recovered from the holidays okay? Or
I'm good. We had a good holidays. It was busy. Kids are off school for a couple of weeks, so lots that's going on, and we kept it fun. Lots of work, lots of fun. We are happy to be back in the regular routine and swing of things, and back to school and business as usual, which is good. But no, it's a good Christmas and good holidays, and everybody had a lot of fun.
yeah, that's good. But there is something to be said about getting back into routine and the swing of things. That's the one challenge with the holidays, is that everyone's off of routine, right? So getting back into the swing of things definitely helps out.
Oh yeah, oh yeah. The little ones will thrive with that as well. So it's no, it's good to be back in things, and we were working a little bit through the holidays as well, so kept our finger on the pulse. What we want to do today, we want to give a little bit of an outlook, and we had, as discussed, I think we probably mentioned it at least a couple times in the video, give a little bit of an outlook of 2026. I mean, things move and change so fast out there. Even as we come into the new year, there's all kinds of things going on in the markets and the world. But give a little bit of an outlook in terms of what we're thinking about markets, what's going on in the world, the economy, a little bit of what to expect as we move forward, some of the big themes, what our technical indicators are telling us, what we're watching and looking out for, and just kind of want to give a high level overview too of kind of where we stand on the portfolio and positioning and all of those things. So it should be pretty interesting. Talking about the big picture outlook here.
Yeah, and also kind of tying in and relating how it kind of relates to our investment process, because it's obviously hard to make, some sweeping prediction at the beginning of the year. But I think what we want to do is just talk about big themes that we're seeing out there and how that's going to tie into everything. But maybe just kind of starting from a macro level, Will, like just high level, and we'll get more granular as we go. Like, what are you kind of like seeing? How are you feeling just heading into 2026 here?
Well, I think first we want to start and look back at 2025, just in saying that, yeah, it was a really good year out of markets. We've had now really three strong years of the markets in 23, 24, and 25, and that's coming off the back of a pretty bad year in markets in 2022, with inflation and interest rates going sky high. But three strong years, and we've had really only one big correction or major correction that's happened in the last 3 years, which is what happened in the spring of 2025. So the whole tariff and liquidation day that happened there. So we've had a pretty calm environment. So I think there's potential for this market this year. I would kind of frame it as that we're cautiously optimistic. So we're constructive on where things are headed, especially in some of the themes with our strategy that we're positioning for this. We're not screaming out that this market's going to be going up 30% or something like that this year. Who knows? It might, given everything that is happening in the world. Also, given what our technical signals and some of the indicators are happening, I think you want to be a little bit cautious. I mean, this year might wind up being a little bit more about protecting what we've got than it is about maximizing returns. But we want to be positioned in the right areas in the right pockets. So we got to stay disciplined. There's a lot of uncertainty out there in the world, in the markets, a lot of unknowns, a challenging time to invest. So we want to stay disciplined to our process, disciplined through all this uncertainty and all the unknowns that are going on out there.
Yeah, and like the markets, all the indices were up double digits last year for the most part. So, Will, would you say like this year it might be more about trying to find like the right areas and the pockets that are actually kind of doing well and showing strength and leadership as opposed to the whole market just kind of going up unchecked?
Yeah, I think we want to be selective. I mean, we have been pretty selective in terms of sectors and positions and names overall, but you just don't know here. There might be broader tailwinds in markets. I mean, if it's a risk on environment, it tends to impact the whole market in general. And if it's a risk off environment, it's going to pull the whole market in. But there's definitely nuance to that. I mean, we've seen it. We'll talk probably a little bit more about that just with commodities and the commodities market in general. Is that energy to start the year based on what's going on this whole geopolitical situation here with Venezuela. Energy's been taking a beating so far. Gold, precious metals have been continuing to thrive from just the chaos and the uncertainty. So I think being mindful of the right pockets, the right names, the right sectors, which lends well to our tactical approach is going to serve well to help navigate through the uncertainty in this environment.
Yeah, and speaking of our approach, like maybe just kind of give us a sense on just big picture. Obviously, our investors, our clients know we use a lot of technical analysis. We look at a lot of charts, just kind of give us a sense what's happening underneath the market and kind of big picture. So, what are our indicators kind of looking like right now as we move into the new year?
Yeah, so shorter term, they are more positive. Let's say for the last month or so, they've been more positive, which is good. And I mean, you've seen that to start the year. I mean, I think our portfolios are up. I mean, it's going to vary depending on the client, but probably around 3% or so to start the year. Some clients more, some clients less than that, depending on the mix and the portfolio. But that's for the first week of the year, which is pretty good. So you're certainly seeing some short term positivity. I would say our longer term signals, especially over the last couple of months since sort of middle to October to early November, are a little bit more mixed or a little bit more muted, which is part of the reason we're more cautious. But with our tactical wealth portfolio, the longer and midterm technical indicators are going to drive decisions. It's not really short-term positioning or short-term trading, but we want to see some longer-term trends and stability. So, that helps with our green light, yellow light, red light process because it's not something that's predictive. It's a process that is disciplined, helps navigate through so many of the unknowns, and often it helps us get ahead of some of the craziness and uncertainty that's out there, but also helps us to capitalize on some of the changes that are happening in the markets because we're listening to the heartbeat of the market. We're looking at, okay, when are markets oversold? When are they overbought? When is there an opportunity to deploy cash? And it helps us just navigate that and take some of that noise of the world and the news and all that the headlines out of there because we're looking at what markets are actually doing. We're looking at supply and demand. So the technical side of it adds this level of discipline that helps us, allows us to navigate through the uncertainty, the unknowns with confidence.
Yeah, and before we get into the themes, just one point on that note is that with our process, we don't have to take on all the risk of the market to try to get, all the returns of the market. As long as we're in the right spots and maybe a little bit more conservative from our overall asset allocation, that's what's going to lead to better results. And that's what our process helps with.
Yeah, and we've had returns this year that have really captured what a 100% fully invested risk on portfolio would give you in this environment. And we've done that with significantly less risk, significantly less volatility, which is what we talked about last week. So that's what we're looking to continue to do. We want to drive those returns. We want to drive those bottom line results, but we also want to manage the risk, manage the volatility, the drawdown, the uncertainty, and that's what our tactical wealth portfolio is all about here.
Yeah, absolutely. So maybe we'll just kind of move into some of like the big themes
Yeah.
that we're at least kind of like looking at as we start the year, but as we know, these could change. It's not set in stone based on everything that's going on. And I think probably the biggest one to start off is just going to be what's going to happen with interest rates, because that seems to be like kind of the biggest driver of markets.
Yeah, it's a big one for sure, and I think that's one of the reasons markets are optimistic now is because the trajectory and the prediction is towards lower rates, particularly in the U.S., which is what the rest of the world and equity markets are going to play off. But markets are forecasting right now for 3 rate cuts, which certainly would be positive. Pretty much the politics and Trump is going to tie through all of this. There's a new Fed chairman coming in, handpicked by Trump. Certainly going to be a dovish Fed chairman. I mean, the bias is towards lower interest rates. So there's potential, which I think is going to be one of the broader themes that we talk about, is that a lot of these themes might be good in the short term. I think the risk when we look at it from a macro perspective is when's the fallout going to happen? When's the other shoe going to drop? Because there's a lot of things that the market likes in the short term, but longer term could create much bigger issues in the market, the economy, the whole world. So lower rates, as an example, that should be and likely would be quite good for markets and our portfolio. The challenge is you saw that in COVID. If interest rates go, if a Fed chairman comes in and says, "Okay, we're going to have 0% interest rates. We're just dropping these down to stimulate the economy." That's just too much stimulus. You get inflation, you get all kinds of fallout that will happen. And we saw that in COVID, that too much stimulus, too much fiscal and monetary stimulus into the economy wound up major issues and major fallout in 2022, 2023. So that's one of these things that I think could be good short term, might have longer term implications because it's how low are rates going to go, how fast is that going to happen, and then is the central bank going to be independent because the market wants an independent central bank. They want though that checks and balances in there, so to speak. And if the idea is that Trump's kind of puppeteering the Federal Reserve, it's going to create issues of confidence and a ripple effect through a lot of other areas of the market.
Right, and there's kind of 2 sides to the equation, like, yes, if interest rates come down, that's gonna be good, but if they're not coming down for a good reason, if they're just coming down for the sake of coming down, markets probably won't like that, so we'll have to monitor that.
Yeah, and there's questions through all this about even credibility of data because some of the moves that have been made. So it'll be interesting to keep an eye on, but the interest rate story is going to be a big one that we'll continue to watch.
Yeah, and then, so that's probably like the biggest theme that we're watching, but there's also a lot of other themes. One of that we've talked about last year is obviously kinda AI and kind of the
Yeah.
continuation and development of that.
I mean, I don't think we can ignore that whole cycle. I mean, it's kind of little bit tech in general has been going sideways. We lightened up on some of the tech exposure a few months ago, but in general, it's kind of been going sideways the last few months. But I think we are in a this big boom and bust and bubble cycle in AI. But I think when you look at what happened in the internet from 95 to 2000, that was about a 5 year bubble type of cycle. I think we're probably in like 96, 97, middle of the bubble. There is a healthy degree of skepticism around AI. Companies that are missing are being punished by the market, punished by investors. I think valuation levels probably would need to be double where they are right now on tech stocks and AI related stocks for it to be at the 1999 type levels. So, I mean, I don't think we're there yet, but it's something we want to be aware of that yes, there's opportunity, there's growth in technology. The AI theme is a big one. It's a huge driver of the markets, the efficiency that's out there, but and a huge driver a lot of the themes, but you've got that potential for the whole boom and bust cycle that at some point that will happen. I mean, I do think we've got a little bit of more runway there, but it's certainly been running hot in general. The other thing to be mindful of is, yes, new technology comes in. That's where the economic growth can happen from. AI should be deflationary over time. Except what's happening right now is everybody's building these data centers, pouring money into AI and power, and so that has the impact of inflation as well, which is another one of these big themes that I think we need to watch for this year is the inflation situation.
Yeah, and just on the point of AI, Will, I know it's still early days in 2026, but just how the markets have started off this year, like kind of TSX, Dow have actually been doing pretty well. Nasdaq has been softer. Some of these AI themes have or AI names like Nvidia have been, little bit weaker. So obviously still early days, but like you are maybe starting to see a little bit of the steam come out and kind of rotating into a little bit more of the value areas of the market.
Yeah, there's a balancing out, which is good and healthy. I mean, we've seen our sort of more number of our thematic stuff has taken off this year so far. Like whether it's some of the defense stocks, like global defense, European defense, those ones based on everything that's going on in the world is up 15%. Uranium's up 20% because you're hearing Google. I think it was Google or Alphabet is building a huge facility to and going to be powered by nuclear, rare earths, gold, and even semiconductors has done well to start the year. So gold equities, those even industrials like Caterpillar, like we've got a lot of positions that are off to a good start here. I mean, still early days in the year, but it's a lot of the trends and themes that we were on to in 2025 are continuing to compound and build for sure. But yeah, you are seeing some broadening out in the market happen as well.
Yeah, which is probably good and healthy for a market. Another one of these themes, and Will, this next theme could probably layer into all the themes for 2026, and that's obviously Trump.
Yeah, and look, this is probably gonna be a charged, topic, but I mean, Trump has I mean, we said for years that politics really don't have they're not impacting the market in day to day, and yes, there's truth to that, especially when you looked at years past, even Trump's first term, and, the day-to-day stuff wasn't impacting the market, but I think we've seen that assumption turned over, this year when Trump, as an example, single-handedly caused a 20% crash in markets when he brought out his tariff big board. So, Trump he matters to the markets. And I know most investors don't like that, but that's the reality is markets are reacting to his tweets, what he says, what he does. There's policy implications. They're running military operations. They're influencing oil markets, right? Just about everything. He's influencing the Fed. So he is impacting markets in a way that we haven't seen from a politician before. It's important. So just a reality to deal with that he's going to be there and not everything has been bad. I mean, look, with first year of Trump was an incredible year in the markets. And I think the way that I think about that is again this short term versus long term is there's a lot of these things that are happening that probably the market is perceiving, not always, but some of them are perceiving as short-term positives for the market and the economy and investors. But what are the long-term implications and when's the fallout going to happen? And that's why we want to manage our process the way we do with caution because we don't know when that fallout's going to happen, right? It could be a geopolitical event, it could be inflation, it could be an economic collapse, right? It could be, the chains have been taken off AI, but it's not really being regulated. So does that create an issue? We don't really know where this next thing is going to come from. So when there's these short-term benefits that are being impacted by policy, yes, they've been good in general, not all of them, but in general, they've been good so far. But when does that fall out? When does the other shoe drop? And I think that's how you have to try to think of the Trump's impact on the market is short term versus long term. And where are things going to be longer term? We don't know, harder to look in, but some of this stuff certainly has been positive, and it seems just about any news, even when you might think, oh man, this is bad news, the market is kind of interpreting it as positive.
Yeah, and, bet no better example than what happened last week with some of, like, the geopolitical tensions coming to the forefront, and that kinda ties in with Trump.
Yeah, and I mean, one of the first orders of business that we even had when Trump came into office is we bought gold, and gold had actually dipped, and so that's one of the things about the position is having a heavy precious metals materials position is sort of an offset to the chaos, and we've had for a while. This goes back to um, probably a couple summers, like summer of 2024. We've had defense type stocks, aerospace, defense, essentially military stocks, which are benefiting from this environment. Broaden that out to global defense, cybersecurity, those areas. So you want to be in positions that deal with this chaos, this geopolitical uncertainty. But that's a theme I just don't think is going away when you look at the headlines this week. What's going on? I don't think that's calming down anytime soon, and it's going to be a major topic. So you want to be in position that will hedge against that. Part of the reason that too we have heavier, say, cash and fixed income balances, not even necessarily that we're entirely negative on the markets, but we just want to be able to be opportunistic, to have a hedge, to take advantage of opportunities that are out there as well.
Yeah, and one of the jobs and what we're doing in the portfolio, like, we wanna kinda benefit from what's going on, and Will, you kinda touched on this earlier in the podcast, but, if you kinda look at gold and, like, energy, those are, like, 2 big components of the TSX. Gold has done exceptionally well, energy has not, so our job and what we're doing is making sure we're in the right pockets, but also making sure we're staying away from the wrong pockets that are going backwards on us.
Yeah, that's the strategy helps guide that. The technical analysis will help guide that, and then also just looking at what's going on out there in the world. The energy is a good example where it's just not. I mean, it's not that these are not like good companies. It's just there's a lot of headwinds against energy right now. I mean, I think what might even be going on when talk to the Trump theme is that a lot of what Trump is doing is inflationary or should be inflationary, whether it's certainly the tariffs, massive spending. So oil has the biggest, most immediate impact, consumer inflation. So kind of flooding the market with oil has the potential to actually bring prices down or to combat that higher inflation. So that might be some of what's going on here, but that's not Trump wants lower oil prices and there's all these things happening. That's not really a great tailwind. Whereas you think of gold as that all the geopolitical uncertainty, central banks, institutional investors, hedge fund, everyone is buying this as a very important asset class that they want to have a strategic hedge against the uncertainty in the world, uncertainty in the US. That just furthers the case for gold here.
Yeah, no, absolutely, and it's interesting because gold and energy are 2 big components of the Canadian market altogether, but I guess another question, and you kinda touch on this, is just kind of this difference between economic resilience, but also potential fallout as it relates to kind of both the US, Canadian, and overall global markets and economy.
Yeah, whether it's US, Canada, that's something we're gonna be watching because it seems like the US, Canada, the global economy has been pretty resilient against everything that is going on. And even with all this, just call it disruption and change that has happened and is happening in the world, economies are adapting, they're figuring it out. I mean, I think people would have thought that Canada was completely in the dumps at this point. If you look at the tariff situation, the relationship with the US, what's happened with energy prices. Well, where's Canada? But somehow the Canadian economy, even housing has not been very good. And that's been such a big part. But the Canadian economy continues to chug along and is just doing fine. The US is doing good as well. You've got that whole AI and technology theme behind it. So I think you're seeing short term, the economy is quite resilient as adapting. I just think longer term is much more uncertain in terms of what might come from all this change because this much disruption that and this much change, usually there's fallout, there's
Yeah.
implications. We saw some of that in the markets in the spring of this year. But there's easily the potential for more of that to come through and ripple through, and it could be a whole host of things, and it probably the disruption, to be honest, is something that nobody's thinking about, nobody's forecasting, is not in anybody's outlook. It's some black swan, some unknown event, which is why part of the reason we want to manage money, we do manage money the way that we do with a technical process that is responsive and able to change and adapt based on changing market conditions.
Yeah, maybe one of these things you want to touch on, Will, because just talking with clients early this year with some of that uncertainty or disruption is what's going to happen with trade between Canada
Yeah.
and the US and like the renegotiation of Kuzma, and that's bringing some volatility to things as well.
Well, yeah, the whole North American trade agreement is gonna have to be renegotiated, but, I mean, who knows? Like, that's probably gonna be some massive bargaining chip. There's probably gonna be all sorts of different interests that are brought in, and I really don't think this is gonna be like we saw in Trump's first term. There's probably all sorts of outside variables and things that are going to come in and who knows? But, I mean, that's something that's gonna be front and center, but cautious to say that, oh yeah, Canada's just going to negotiate this and get a good deal and be like, okay, we're done. That's the end of it. This is probably going to be continued, ongoing issues with this, but we'll see. But that just the trade uncertainty is going to continue to linger there and is going to be one of the themes that's out there for sure.
Yeah, and just general tariffs altogether. And so some of, to your point earlier, maybe some of the fallout from some of these tariffs that have been implemented as well. But kind of like these last two themes that we're looking at, Will, I mean, they kind of tie in together. They also kind of tie in with some of the themes we've talked about. It's just this thing about inflation and then obviously the Fed and the independence.
Yeah, I mean, it's something again to keep a big eye on are the inflation numbers, just because there's a lot of, especially in the U.S., a lot of the policy is has the potential to create inflation, and I think we'll be watching that. We talked about that before the central bank, Fed independence. The market wants a, stable, independent Fed making their own decisions. So those are some of those risks that if we don't get that, who knows? All bets are off, right? If we start to see inflation numbers creeping in, I mean, I wouldn't be surprised if inflation starts to creep up, if data starts being questioned. That's where when investors, Wall Street can't trust the numbers, that's where risk comes in. The one thing I'd say which gives me some confidence is Trump listens to the market. That's a gauge of his success, his popularity. And so even if policies are going against the market, I think we saw in April that he has the ability to shift and adapt potentially to try to have more sort of Wall Street investor friendly policy or at least messaging. So one would hope that the understanding is that a independent Fed is good for the markets and that issue can be put to bed, but that will be one of these themes here. But yeah, I mean, again, unfortunately, like it or not, is that the Trump story is going to be one that continues to run through the markets probably for the foreseeable future. And to ignore that and say, oh no, it doesn't matter, I think is probably it's a little bit silly, and it's rippling through. But there's a lot going on out there. It's a complex market, complex political situation, complex economy, of course, and we're here to work and navigate and help you steer through it, manage the risks, take advantage of opportunity. So again, to kind of tie this off, we are constructive, we're optimistic, but we're cautious. We're staying disciplined to our process through this uncertainty and all the unknowns, but we think we could have a good year in 2026 and looking forward to seeing how things play out here.
Yeah, looking forward to a successful 2026 and just kind of continuing the good returns and the strength that we saw from 2025.
Oh yeah. So as always, we want you to be wealthy, and we're seeing that, which is good to start the year. Things are going up. They're moving in the right direction, which is nice to see to kick things off, and especially coming after a very good 2025. We want you to feel wealthy. I mean, I wouldn't pay too much attention. Don't be glued to the news out there because it's absolutely crazy, and that's I think part of feeling wealthy and not being too concerned or worried about what's happening in the world. We want you to realize your wealth. That's what we're all about. That's what Aretec wealth is all about. That's what we're here for. So looking forward to a successful 2026, and we'll be back with everybody soon.
See you soon.